Welcome to the Fear and Greed Business News Afternoon Report for Monday, the 4th of September 2023. I'm Michael Thompson. Every afternoon, we've got the 5 stories that happened today that you need to know about. So let's jump into story number 1. The S&P ASX 200 closed up 0.6% today to 7,319 points after a pretty strong trading day. Resources, as well as metals and mining, were the best performing sectors. Consumer staples and healthcare performed worst. West Australian lithium business Liontown Resources topped the leaderboard today, up 8.8%. It announced a $3 a share proposal from New York chemical giant Albemarle, amounting to a $6.6 billion takeover bid. The board is recommending shareholders accept the offer. This is Albemarle's third offer in 5 months, so if it sounds a little bit familiar, that's why. And it's a 15% premium to the share price pre-announcement. Uranium mining company Paladin Energy was up 6.9%. It's up about 20% over the past month as investors expect it to benefit from nuclear-powered submarines under the AUKUS deal and potentially from renewed interest in nuclear energy as well. Lake Resources was the worst over the day, down 7%, followed by Bendigo and Adelaide Bank, which is now trading ex-dividend, down 3.5%. Qantas fell 2.9% after another bruising day. It's at its lowest level in 11 months. On to story number 2 now, and the Australian arm of the Hilton hotel chain has taken the ATO to federal court to argue over an assessment that says it owes $80.7 million in unpaid taxes, penalties and interest. The Sydney Morning Herald reports that the Australian Taxation Office reckons it owes $51 million in taxes following the sale of its Hilton Sydney property in 2015. It received $442 million for the sale. The ATO says a capital gain wasn't properly recorded during this period, though the actual amount it thinks it's owed isn't public because of court redactions. The ATO is accusing the hotel of using a business structure and scheme specifically to avoid tax, but Hilton's defence says this assumption is incorrect and the scheme was to achieve commercial objectives. There will be another hearing in April next year. Story number 3, the spring property selling season has kicked off with a few kind of mixed results, I suppose you'd say. Last week was the busiest one since about Easter, with about 26% more homes listed than the same time in 2022. The combined preliminary clearance rate of 71.2% is a touch lower than the week before at 72%, so only just lower. Almost 1 in 10 homes was actually withdrawn before they went under the hammer, which was the biggest contributor to that slight decline. At the same week the year before, under 60% of homes were successful at auction. Melbourne's auction numbers actually fell, down about 8% last week, and the clearance rate eased. Sydney's still very busy, but it did just record its lowest clearance rate in 4 weeks. Story number 4, Aussie unicorn Canva was singled out by the financial watchdog as a test case for how hundreds of billions of dollars worth of unlisted assets are being valued and treated by super funds. Now, this is an issue that we've talked about a fair bit on Fear and Greed. Canva was specifically chosen because the company is high profile and its value has been somewhat volatile. The review from the Australian Prudential Regulation Authority found most of the governance practices related to valuations of Canva were appropriate, so that would be a big sigh of relief, you would imagine, to most of the super funds. But there were some areas of concern needing improvement, including some funds being too slow to revalue Canva. Now, bear in mind, we don't actually know which super funds were being reviewed, and APRA says there weren't enough interim revaluation triggers in valuation policies, not enough info given to boards, and skill set gaps among directors who therefore might not have been as willing to challenge the information provided to them. And finally, story number 5, the Future Fund has published modelling to show the impact to taxpayers if it was liquidated. And these estimates show that we would all be much worse off. So the background to this, in August, the Centre for Independent Studies called for the liquidation of the Future Fund, saying that the government could save a big chunk of money to the tune of about $10 billion a year by using the proceeds of the Future Fund to pay down the nation's debt. And we could shave 25% off the $896 billion or so overall debt balance. But the new modelling conducted by Willis Tower Watson shows that taxpayers would be out of pocket by about $200 billion over the next decade should this happen, because the Future Fund is expected to outperform the cost of government debt. The Financial Review reports Future Fund Chairman Peter Costello saying calls to liquidate the fund are, quote, poorly conceived and would damage prospects for future Aussies. So there you go. That's it for the afternoon report for Monday, the 4th of September 2023. Don't forget to hit follow on the podcast and find Fear and Greed on LinkedIn, Instagram, X and Facebook. Join us tomorrow morning for the Tuesday edition of the Fast 5 Business News by Fear and Greed. Top 5 business stories in just 5 minutes. I'm Michael Thompson. Enjoy your evening.